ETFs and mutual funds are silently stealing from your returns all day, all night, 365 days a year. And it's all legal, of course. If you haven't caught on, I'm talking about the fees charged by these funds. You'll often find them described as management expense ratio or just expense ratio. Now you might be thinking, what's the big deal here? We get charged fees on many things. The problem here is the nature of the fees and how they can eat up to a fifth of your returns over a 25-year time frame. So in this video, I'm going to explain what these fees are, how it's negatively impacting the long-term value of your portfolio, and what steps you can take to minimize this impact. So what is expense ratio? The expense ratio contains the salaries of the portfolio managers, commissions paid, and other operating expenses to keep the fund running. It is expressed as a percentage, which is calculated by adding up these expenses and dividing by the fund's average net assets. For example, if it costs $1 million per year to run a mutual fund with $1 billion of net assets under management, the expense ratio would be 0.1%. Passive funds like ETFs charge below 1%, and actively managed funds like mutual funds can charge between 1 and 2%. In terms of its impact on the long-term value of your portfolio, the expense ratio is an important number to review when you're considering any type of fund. It's charged whether the fund increases in value, decreases in value, or stays flat. An example should illustrate this better. Let's say you invested $100,000 into a mutual fund with an expense ratio of 2% over 25 years. Assuming that the fund generates 6% return per year, the value of your portfolio after 25 years would be just under $430,000. That's a nice tidy sum of money, right? Except you're not getting 6% each year. You're actually getting 6% minus 2% fees, which equates to 4% return each year. Now the value of your portfolio after 25 years would be $267,000. The expense ratio of the fund has eaten up 38% or $162,000 of your gross returns. That amount could be the down payment on an $800,000 house, or 4 Honda Civics, or 4 years of university tuition. Now, I'll grant you that a 2% expense ratio is on the high end, which you would only find in actively managed funds. And it's debatable whether actively managed funds generate enough returns to justify this cost, but that's a whole other video. Instead, let's say you invested the $100,000 into an ETF with an expense ratio of 0.2%. Assuming the same 6% annual return, the value of your portfolio after 25 years would be $409,000. The ETF has only consumed 5% or $20,000 of your gross returns in fees. The reason as to why expense ratio has such a dramatic effect on your portfolio value is because each dollar of fee charged is a dollar that is not compounding over time. So small fees charged every single year can snowball into a large effect of suppressing your long-term returns. Here's a chart to visualize the magnitude of this impact. Using the same $100,000 investment in a fund that returns 6% per year, the x-axis of this chart represents the different expense ratios ranging from 0.03% on the low end to 3% on the high end. The y-axis represents the value of the portfolio after fees as a percentage of the gross returns. The larger this percentage, the more returns you end up keeping. As you can see, with an expense ratio of 0.03%, you retain 99.3% of the gross value after 25 years. You only lost 0.7% to fees. As you increase the expense ratio, the amount of gross returns you keep drops quite dramatically. On the high end at 3%, you only keep 48.8% of gross returns, so you lost more than half of your returns to fees. So what steps can you take to minimize the impact of fees? Invest in passive funds like ETFs, which charge lower fees. Some popular examples are VOO and VTI. The expense ratios for these funds are quite low at 0.03%. And from the chart, we can see that this expense ratio consumes less than 1% of your gross returns. It's practically free. The added bonus here is that most online brokerages don't charge trading fees when you buy ETFs. If you want even lower costs, i.e. pay no fees at all, then buy individual stocks instead. though be aware that you are likely going to be charged one-time trading fees by your brokerage. The key takeaway from this topic is that if a fund charges an expense ratio of more than 1%, just walk away. Unless you really believe in the fund, and even then, I'd really question that. With that said, what would you do in this situation? Are there funds with higher expense ratios that worked for you? Leave a comment below. As always, if you found this video useful, give it a like and subscribe to the channel. I'll see you in the next video.